Let's start with a question you might not have asked yourself yet. What exactly is a rogue trader? Sounds like someone shady lurking in the shadows of Wall Street, right? Well, you're not far off. A rogue trader is basically a financial employee within a bank or trading firm who takes unauthorized, often massive risks with the company's money. Risks that are way beyond what they're officially allowed to take. Imagine driving a Ferrari at breakneck speed on a crowded street when you're only supposed to be cruising. That's the kind of rule-breaking we're talking about here. Now, why does this matter to you? Because these shadow moves can cause losses in the billions and even bring down entire banks, shaking the financial system that keeps your cash flowing. In the world of finance, traders usually have clear limits set by complex risk controls and internal policies. These limits tell them how much they can trade, when to stop, and what kinds of financial instruments they're allowed to deal with. Sounds like a fortress of rules, right? But rogue traders find sneaky ways to bypass these rules. Think of it like finding secret tunnels under a castle wall. They can hide their losses or fake trades to cover up their risky bets. So, when things go south, nobody even realizes what's brewing beneath the surface until it's way too late. You're probably wondering, why would someone risk it all on unauthorized trades? The simple answer is the chance of big rewards. If a trader bets on a high-risk trade and wins, they can earn enormous bonuses and look like a hero. But if that bet fails, guess who ends up carrying the losses? The bank, and by extension, regular folks like you and me. It's a classic moral hazard, big upsides for the trader, but painful downsides for everyone else. This makes rogue trading one of the most dangerous gambles inside finance, hidden under a glossy surface of profits. Now, isn't it wild to think these traders are actually employees of the bank, trusted to manage huge amounts of money? They're not some outsiders. They've got keys to the kingdom. They can enter trades on behalf of the bank, but with one big catch: only within strict guidelines. When they step beyond those guidelines without permission, that's when they become what we call rogue. It's like being given the wheel but driving off-road without telling anyone, and sometimes crashing spectacularly. In some cases, these rogue traders punish their employers with losses that run into billions, sometimes even bankrupting the bank itself. You might have heard about Nick Leeson, who nearly sank Barings Bank back in 1995 with unauthorized trades hidden away from his managers. Or Jérôme Kerviel at Société Générale, whose secretive trading cost billions and showed just how fragile bank oversight can be. These aren't small-time stories. They're blockbuster financial disasters that put the spotlight on how easy it can be for a single trader to wreak havoc. And when that happens, it's not just the bank's problem, it can ripple through entire economies. What's even more interesting is that some rogue traders actually start out making real profits. In fact, some traders who end up losing millions initially brought in big gains for their bosses and themselves. This just makes it harder to spot when things go off the rails. It's like a movie plot where the good guy turns rogue slowly and everyone around is too dazzled by the winnings to see the risks piling up. It's a dangerous game and one that financial institutions struggle to police. So, what type of financial instruments are we talking about here? These traders often play in markets like stock index futures, foreign exchange, commodities, or options. These instruments carry high risk, but also the potential for massive returns if timed perfectly. But remember, when these bets fail, losses can be catastrophic. The problem is, these markets move fast, and sometimes internal checks just can't keep up, especially if a trader is deliberately hiding their tracks. The systems in place to catch rogue trading involve a mix of technology, audits, and risk management frameworks. Banks use fancy models like value at risk, which try to estimate the maximum expected loss over a period under normal market conditions. But these models rely on accurate data and honest reporting. If a trader cheats the system or understates risks, these models become useless. Plus, in the heat of trading floors where pressure is sky high, oversight can slip, giving rogue traders their playground. Ever wondered if rogue trading is just a problem of the past? Not really. Though technology has improved, rogue traders have adapted too, finding new ways to manipulate systems. The digital age allows trades to be executed in milliseconds, and tracking each one is like chasing a moving target. Banks invest heavily in controls and surveillance, but it's a cat-and-mouse game that never really ends. Okay, let's zoom out for a moment. Why should you care beyond the banking headlines? These rogue traders don't just affect CEOs or traders, they can threaten your savings, investments, pensions, and even the broader stability of financial markets. When a bank collapses or takes huge hits, governments might have to step in with bailouts using taxpayers' money, maybe even some of yours, to patch things up. So, the reckless bets of a few traders can ripple out and touch your personal finance in ways you might never expect. At this point, you might be asking, how do banks end up with rogue traders inside their ranks? Well, it's complicated. It's not like the bank wants bad actors lurking their halls, but the pressure to deliver profits, the complexity of financial products, and sometimes weak supervision create the perfect storm. Some traders even operate in a culture where bending rules is an unspoken norm, pushing the envelope till something breaks. Let's wrap up this intro with a quick recap. A rogue trader is an employee who takes unauthorized, huge financial risks, often hiding losses and betting big on unstable grounds. They can bring down banks and cause waves that unsettle global markets. Behind the scenes, loopholes in internal controls and pressure to perform feed this risky behavior. So yeah, it's a pretty serious cocktail of factors. So, are you ready to dive deeper? We're about to unpack the most notorious rogue trader stories, breaking down how these individuals pulled off the heists of the financial world and what banks did or failed to do to stop them. Buckle up, because this roller coaster through history and finance is going to be anything but boring. Imagine this, a bank that's been around for 233 years, financing massive deals like the Louisiana Purchase back in 1803, suddenly vanishes because of one guy. Yeah, you're thinking of Barings Bank, and the man behind it all was Nick Leeson, the rogue trader who turned a powerhouse into dust in 1995. Have you ever wondered how a single employee could bring down an institution that survived wars and crises? Well, buckle up, because this story is the perfect cautionary tale of hidden risks exploding out of control. We're diving right into how Leeson pulled it off and why the bank's so-called safeguards were basically paper tigers. Let's set the scene in Singapore, where Barings Futures Singapore, or BFS as they called it, was humming along in the early 90s. Leeson, a young hotshot from London, gets sent over to run the show, handling both trading and the back-office settlement, which is like being both the chef and the accountant in a busy restaurant. Normally those roles are split to keep checks and balances, but Barings messed up big time by letting him do both. Why does that matter to you? Because without separation, he could cook the books however he wanted, hiding mistakes and bad bets from everyone back in London. It's the kind of setup that screams trouble, and boy, did it deliver. Everything starts innocently enough, or so Leeson claims, with a subordinate's goof-up in 1992. This junior trader was supposed to buy 20 futures contracts for Fuji Bank, but sold them instead, costing Barings £20,000. Instead of fessing up and risking his rep, Leeson buries the loss in a secret error account numbered 88888, meant for tiny mistakes only. You're probably asking yourself, how does a small slip turn into a catastrophe? Well, that account becomes his black hole for all future losses, and soon he's feeding it his own unauthorized trades to chase profits and look like a star. By the end of 1992, that hidden pot of losses hits £2 million, but Leeson doesn't stop there. He's betting big on Nikkei 225 futures. Those are derivatives tied to Japan's stock index, basically leveraged bets on where the market's headed. When he wins, Barings loves it. He pockets a bonus of £130,000 on a $50,000 salary. But losses pile up, and by late '93, the secret account balloons to £23 million. Isn't it crazy how early wins blind everyone to the growing storm? Leeson keeps doubling down, thinking he can trade his way out, but it's like digging a deeper hole to escape a pit. Fast forward to 1994, and things get really hairy, the year Barings staff dubbed the Turbulence. Leeson's switching trades between Singapore's Simex exchange and Japan's Osaka, arbitraging tiny price differences, but mostly he's speculating wildly without permission. The error account now swallows nearly 300 million Singapore dollars in losses by December. London brass gets an audit warning about risks at BFS, but they ignore it because Leeson's delivering 10% of the bank's annual profits. Ever pause to think why bosses dormirse en los laureles when profits roll in? That's exactly what happened, letting the rogue run wild. Now picture January 1995, the Kobe earthquake hits on the 17th, cratering the Nikkei index overnight. Leeson's massive long positions bets the market would rise, get hammered, and Barings can't meet the margin calls flooding in. He's desperate, doubling and redoubling bets to recover, but it's futile. Losses skyrocket to over £800 million, twice the bank's entire capital. Supervisors in London start sniffing around discrepancies, but Leeson spins tales, faking documents like a payment statement from a US firm. You're wondering, how did no one catch this sooner? Turns out, with him controlling front and back offices, oversight was a joke. No real audits pierced the veil. On February 23rd, Leeson leaves a note saying, "I'm sorry," and bolts to Malaysia with his wife, leaving chaos behind. Auditors uncover the 88888 account the next day, revealing 2.2 billion Singapore dollars in obliterated value. Barings tries a bailout, but it's too late. On the 26th, the 200-year-old merchant bank declares insolvency and sells to ING for £1 measly. Can you feel the tension building? One rogue trader wipes out centuries of history because controls failed spectacularly. It's a wake-up call on how fragile even prestigious banks can be. Let's break down Leeson's tricks, because understanding them shows why rogue trading thrives. He used that error account to park losing trades, then fabricated offsetting deals to make books balance. Fake buys and sells that cancelled out on paper, but hid the truth. No one reconciled positions properly since he oversaw settlement too. Plus, Barings funneled cash from London unquestioned to cover margins, treating BFS like a profit machine. Isn't it wild how trust and greed blinded them? This combo of no segregation, poor audits, and profit pressure created the perfect rogue playground. You might be thinking, did Leeson pocket millions personally? Investigators found about $35 million in accounts linked to him, but he swears it wasn't for gain, just survival. Arrested in Germany after fleeing through Asia, he's extradited to Singapore, convicted of fraud, and sentenced to 6.5 years in Changi prison. He serves 4, gets out in '99 with health issues from cancer. Today, he's a cautionary speaker, but back then, his story shocked the world. Ever asked yourself if you'd spot a Leeson in your own job? These tales hit close because they expose human flaws in high-stakes finance. Zooming out, Barings' collapse forced regulators worldwide to rethink risk management. The Bank of England probe slammed managerial confusion and control failures, not complex products. It was basic stuff like separating duties they botched. Futures and options amplified losses via leverage, turning small errors into billions, but the real killer was unchecked authority. Banks scrambled to beef up surveillance, yet rogues persist. Why do you think that is? Often it's cultural, chasing bonuses over safety nets that traps. Think about the ripple effects on folks like you. Barings' fall shook investor confidence, spiked scrutiny on derivatives, and cost jobs galore. Governments pushed for better oversight, birthing rules like real-time monitoring that we see today. But here's the kicker. Leeson's early profits fooled everyone, showing how rogues hide in plain sight amid success. If you're eyeing finance careers or investments, this screams, do your homework on any bank's risk culture. No te ligo con eso, ¿vale? It's your money at stake too. What made Barings so vulnerable? A mix of rapid expansion into Asia without proper controls, over-reliance on one-star trader, and ignoring red flags like massive position sizes. Cymex even queried the huge Nikkei volumes, but Barings vouched blindly. Internal memos warned of dangers, yet profits silenced doubts. Ya sé lo que estás pensando. How could they be so naive? Greed and complexity clouded judgment, proving even old banks can crumble fast. Ponte comodo as we connect this to bigger lessons, because Barings wasn't a fluke. It set the stage for Société Générale and others. Leeson showed how one person exploits silos in massive organizations. Today, with algorithmic trading, risks evolve, but human oversight gaps linger. Have you considered how this affects your savings in big banks? Next up, we'll unpack Kerviel's saga, but first, reflect. Could a rogue trader hit your financial world tomorrow? That's the tension keeping finance thrilling and terrifying. Vale, before we roll on, quick reality check. Stories like this aren't just history. They remind us investing has risks, and this vid's no financial advice, always DIOR. Barings teaches that unchecked ambition plus weak controls equals disaster. You're now armed with the blueprint of rogue trading's first mega blowup. Isn't it eye-opening how one error account snowballed into oblivion? Let's jump over to France, where a junior trader named Jérôme Kerviel pulled off one of the biggest rogue trading scandals in history. Société Générale, a giant in the banking world, nearly collapsed in early 2008 because of Kerviel's unauthorized trades, which racked up losses around 5 billion euros. Now you might be asking, how does a regular employee pack such a punch without anyone noticing? Well, that's the story we're unpacking here, how Kerviel exploited the system's blind spots and why Société Générale's controls failed him spectacularly, almost bringing one of Europe's biggest banks to its knees. Kerviel was originally assigned as a trader dealing with derivatives arbitrage, meaning he worked on spotting and exploiting tiny price differences between different but related financial instruments. Sounds complicated? Think of it like spotting the tiny difference in prices between two stores selling the same phone model and trying to profit from that difference. At first, his trades seemed legitimate and even profitable, with the bank getting a nice boost from his activities. However, Kerviel began crossing lines, creating fake trades or phantom transactions to hide the real position sizes, allowing him to take far larger risks than his mandate allowed. In late 2006 and early 2007, those small fake trades started multiplying. Over time, his footprint grew massively, with some of his unauthorized trades reaching a jaw-dropping 50 billion euros in exposure. How could the bank's risk management let this happen? Well, the controls were designed to catch discrepancies, but Kerviel had intimate knowledge of the system's monitoring tools and often deleted or manipulated records to evade detection. You could say he was playing a shadow game alongside his visible trades, inserting falsified data to cover his tracks. Interestingly, during 2007, Kerviel's trades showed real profits, about 1.4 billion euros by year-end, but he concealed this using false data, possibly to mislead his managers and keep the ruse alive. When the market turned early 2008, those massive one-sided bets backfired hard, wiping out the prior gains and plunging Société Générale into an estimated loss just shy of 5 billion euros. That's not pocket change. It's the kind of hit that shakes markets and triggers loud alarms in every bank's trading room. You might be thinking, weren't the bosses aware of such huge risks? It's complicated. Kerviel claimed management turned a blind eye to his trades while they were making money, but denied knowledge of the ultimate size and risk. When the control systems finally flagged serious irregularities in January 2008, Société Générale launched an internal investigation and discovered the massive facade Kerviel had built. Picture a team scrambling overnight to untangle a web of fake trades and shadow positions. The revelation was staggering. Kerviel had systematically abused internal controls, entered hundreds of fictitious trades, and forged emails and documents to fend off scrutiny. His knowledge of the bank's systems gave him the ability to anticipate and neutralize alerts, sometimes by deleting suspicious trades and recreating them to dodge the alarms. As the scandal burst into public view, debates erupted over whether Kerviel was a lone wolf or a symptom of deeper systemic issues. His defenders argued that Société Générale's culture, focused heavily on hitting aggressive profit targets, created the conditions for his actions. Critics pointed to glaring management failures and inadequate oversight. This tug of war continues even today, with courts sometimes siding with Kerviel, claiming the bank ignored warning signs, and other times backing the institution's claims of betrayal. Kerviel was charged with breach of trust, forgery, and computer fraud. In the legal battles that followed, he admitted to concealing his positions and forging documents, but maintained he never tried to profit personally, and that the bank should have known about his trades. He served 5 months in prison and was initially ordered to repay the full 5 billion euro loss, a figure later reduced substantially. Beyond the courtroom drama, this saga sparked serious soul-searching in the banking world about how such colossal failures in internal controls could occur in a top-tier institution. The ways in which Kerviel manipulated Société Générale's system are pretty wild. He would enter trades into the bank system, then enter opposite fake trades to make his positions appear hedged when they were anything but. This double bookkeeping trickery hid the real risk exposure from risk managers. When alarms went off, he crafted plausible but false explanations and forged emails to support his cover stories. It was a sophisticated game of cat and mouse within the bank's own IT systems. You can almost imagine him sitting at his desk, clicking furiously to keep the illusion intact. The bank admitted that several of its middle and back office employees were fooled by Kerviel's forgeries and false data. Think about it. People whose job it was to double-check trades were swindled by clever manipulations of electronic records. The lesson? Even the best human eyes and systems can be outwitted when inside knowledge and deceit combine. This highlights why behavioral and cultural risks are as important as technical controls in financial institutions. From an outsider's perspective, it might seem that technology would catch every trick in the book. But Kerviel's saga shows that when someone knows the system inside out and is motivated by risky ambition, controls can crumble. Banks responded by improving risk management systems and adding layers of surveillance and verification. However, the paradox remains: the more complex trading gets, the more potential blind spots are created. You might be wondering, why would Kerviel take such insane risks? Part of it is the fierce pressure to perform that traders in big banks live under. Bonuses often depend on short-term profits, and ambition can push people to skirt rules or look the other way. The culture of winning, combined with insufficient checks, can create an environment ripe for disasters. This is a reminder that hard numbers aren't the only thing at play. Emotions, incentives, and corporate culture matter hugely. Think about the impact on society. When rogue traders cause multi-billion euro losses, it's not just the bank's shareholders who suffer. Thousands of jobs can be at risk, markets can wobble, and taxpayer-backed bailouts become a threat. Understanding these mechanics is crucial if you care about where your savings are and how stable your financial system really is. So, what can we take away from Kerviel's story? It's a sharp lesson in how even cautious systems fail when someone with enough access and cunning pulls the strings. Systems alone aren't foolproof. It takes vigilant, ethical people and a culture that prioritizes long-term soundness over quick wins. That's something you should keep in mind, whether you're an investor or just someone curious about the finance world's hidden dramas. Alright, this tale from France already feels like a thriller, with secrets, money, betrayal, and heavy consequences. Next, we'll shift focus and dive into another big case at UBS, where unauthorized trading also sparked massive losses. But don't lose the rhythm, because understanding these stories helps you see why financial stability is fragile and how your own money might be indirectly affected. Stay tuned. Alright, now let's jet over to London and Zurich, where UBS, the colossal Swiss bank, was shaken to its core by unauthorized trades worth over $2 billion. The man behind this financial earthquake? Kweku Adoboli, a young trader with big ambitions and even bigger risks lurking in his portfolio. This chapter is your backstage pass to how his actions nearly sent one of the world's toughest banks reeling, and what it teaches us about loose controls and the dangers of unchecked ambition. Adoboli started his career at UBS in 2003 and moved up to a trader position by 2006, operating in the global synthetic equities division. This means he traded complex products like exchange-traded funds, which track baskets of stocks, bonds, or commodities. Sounds technical, but think of it like buying a variety pack instead of single items, which can be convenient but also riskier. His job was to buy and sell these ETFs to make the bank profits, but here's where things got tricky. Over time, he began breaching the bank's daily trading limits and hiding unauthorized positions in fake client accounts and bogus trades. In fact, Adoboli's unauthorized positions exploded so massively that at one point he put UBS at risk of losing up to £7.5 billion. That's about $12 billion. Now ponder this. How does one guy build a secret slush fund of phantom trades without getting caught by one of the most sophisticated banks in the world? Well, it involved fabricating fake counterparties and hiding trades under the carpet, making it look like hedging, but really leaving UBS exposed to huge, uncorrected risks. Internal controls failed to detect the full scale, partly because Adoboli knew exactly how to bypass them. The saga came to light in 2011 after an internal investigation triggered by suspicious trade records. Adoboli confessed in an email to his manager about the bogus trades and the mounting losses. At the time, the bank's share price took a nosedive, wiping billions off its market value. This was a shock not just for UBS investors, but for the entire financial system, because it happened during the height of the Eurozone debt crisis, adding extra stress to markets already on edge. So, it wasn't just an isolated rogue trader story, It was a major blow to confidence, right when the global economy was fragile. The trial in London was intense. Prosecutors painted Adoboli as a gambler who thought he had a magic touch and wanted it all: bonuses, fame, and power. Adoboli, on the other hand, insisted he acted with the bank's interests in mind. He saw his colleagues as family and said he lost control amid the financial chaos. He claimed senior managers encouraged risk-taking up to a point, and he crossed lines nobody foresaw. Whether you buy his story or not, the court found him guilty of fraud and sentenced him to 7 years in prison in 2012. He served 2.5 years before being released. What makes this story stand out compared to Barings or Société Générale is the sheer complexity and scale of the trades, which were designed to be riskier and riskier without the bank's knowledge. Adoboli hid losses by entering false trades on his computer screens and even created fake clients to make the trades look legitimate. These phantom transactions helped cover huge bets on Eurostoxx, DAX, and S&P 500 indexes. When markets turned, UBS was hit with colossal losses that forced the bank to restructure and rethink its entire trading operations. This scenario highlights a repeated theme. Even large banks with advanced risk systems can be blindsided if someone inside knows the loopholes. Adoboli exploited gaps in UBS's monitoring and approval processes, revealing that technology alone can't solve risks when human ambition and flaws intervene. He didn't just take reckless bets, he actively falsified records to hide them. That's a huge red flag for anyone thinking controls are infallible. You might be wondering what UBS did wrong here. For starters, the bank allowed traders too much autonomy without sufficient supervision. The culture promoted aggressive trading and risk-taking, expecting managers to keep things in check. Meanwhile, Adoboli's activities went unchecked for years, exposing both governance and compliance weaknesses. Post-scandal, UBS had to pay millions in fines and overhaul its control systems to prevent a repeat. The ripple effects were significant, investors lost billions, and thousands of employees faced uncertainty as the bank scrambled to recover. Beyond finances, UBS's image as a stalwart of Swiss banking took a big hit. The scandal also ignited debates about responsibility. How much should management be blamed for fostering an environment where risk limits get ignored? Did they sleep on the job while Adoboli went rogue? These questions still echo in finance circles today. So, what lessons does the UBS case teach you as a bystander or investor? First, it's crucial to understand that financial institutions aren't invincible fortresses. They're run by humans, with all the flaws and ambitions that come with us. Second, robust internal controls need to be paired with a corporate culture that genuinely values ethical conduct and open communication, not just profits. Otherwise, you risk having a Kweku Adoboli in your bank's shadows. Finally, think of this chapter as a real warning shot. When these unauthorized trading losses surface, it's more than numbers. It's about real risk to your money and the financial ecosystem. UBS's journey from scandal to reform may offer hope, but also a reminder. Vigilance and skepticism in finance aren't just smart, they're necessary. Up next, we dive into how rogue traders manipulate systems and why controls often fail. But for now, absorb this tale of ambition, risk, and lessons learned from one of banking's wildest rides. Now that you've seen Barings, Société Générale, and UBS up close, you're probably wondering, how do these rogue traders actually pull off their tricks without getting caught right away? It's not magic. It's a deadly mix of insider knowledge, clever hacks, and systems that just aren't bulletproof. Think about it. Nick Leeson had his error account. Kerviel faked trades left and right. Adoboli invented clients from thin air. Vale, let's break it down step by step so you can spot the patterns yourself and understand why even big banks dormers en los laureles when it comes to real oversight. First off, rogue traders thrive on what's called segregation of duties failures, like Leeson running both trading and back office at Barings. Normally, front office executes trades, middle office checks risks, and back office settles them, 3 separate teams watching each other. But when one person controls it all, they can enter a trade, fake the confirmation, and bury losses in hidden accounts. Have you ever played a game where you make the rules? That's what these guys do inside massive banks. Without that separation, it's like leaving your wallet open on a crowded street. Take Leeson's infamous 88888 account at Barings. It started as a tiny error spot, but became a black hole for massive losses. He'd park losing futures bets there, then create phony offsetting trades to make the books balance on paper. No one reconciled positions properly because he oversaw settlement too, so London just saw profits flowing in. Isn't it crazy how a simple loophole snowballs? You see the same in Kerviel, who entered massive directional bets on equity futures, then slapped fake hedges on top to dodge risk alerts. Pure digital sleight of hand. Adoboli at UBS took it further with phantom counterparties, inventing clients and trades that didn't exist to hide naked exposure on stock indexes. He'd book a real long position, then a fake short with a non-existent broker to look hedged. When margins called, he'd delay confirmations or forge emails saying, "all good." Ya sé lo que estás pensando. How do systems miss this? Well, controls rely on data feeds and human verification, and insiders know exactly where to poke holes. It's a cat and mouse game where the mouse knows the house layout. Another big trick is exploiting time lags in reconciliation. Trades settle daily or even later, giving rogues windows to manipulate records. Kerviel deleted alerts from the bank's Eurex system, knowing the exact sequences to bypass flags. Leeson arbitraged tiny price diffs between Cymex and Osaka, but mostly speculated wildly, funding margins with unquestioned cash from HQ. Ever asked yourself why audits don't catch it sooner? Because rogues time their fixes around check cycles, and early profits blind supervisors to red flags like unusual volumes. Now, why do controls fail so spectacularly? Start with value at risk models, or VAR. These fancy math tools estimate max daily loss under normal conditions, say 99% confidence. Sounds solid, right? But VAR assumes honest data and misses tail risks, those black swan events where markets crash hard. Traders like Kerviel fed it garbage inputs, understating volatility to greenlight huge bets. Plus, stress tests are often backward-looking, not catching novel strategies. No te ligo con eso, but if your car's speedometer lies, you're cruising blind. Cultural pressures amplify the mess. Bonus-driven trading floors reward short-term wins, ignoring long-term bombs. At Société Générale, Kerviel claimed bosses cheered profits but ignored queries. UBS pushed aggressive targets post-crisis. Supervisors get dazzled by P&L sheets showing stars, overlooking position sizes. Why chase the hero when numbers sing? This moral hazard lets rogues build empires until markets turn, then poof, billions gone. It's human clashing with high-stakes finance. Technology cuts both ways too. Ultra-fast algo trading overwhelms legacy systems not built for millisecond volumes. Adoboli exploited ETF delays where confirmations lagged hours, enough to tweak logs. Banks layer on AI surveillance now, but rogues adapt with VPNs or insider logins. Páralo y vuelve a verlo if this hits home. Even post-scandals, hacks evolve faster than patches. Remember, complexity breeds shadows. Simple derivatives in Leeson's day ballooned to today's hyper-engineered products. Weak middle office is another killer. Understaffed juniors verify billions daily against savvy traders who know every shortcut. At Barings, no one cross-checked Cymex positions with London books. Kerviel fooled back office with forged docs, mimicking real brokers. Supervisors face volume overload, missing patterns like one trader dominating flows. Have you considered how burnout plays in? Tired eyes skim alerts, letting anomalies slide till it's catastrophe o'clock. Regulatory gaps fuel the fire too. Pre-Barings, exchanges like Cymex didn't demand full client details, letting Leeson fly under radar. Post-scandals, Basel rules mandate better capital buffers and real-time reporting, but enforcement varies. National silos mean Singapore missed Barings' UK risks. Global markets, fragmented oversight, perfect rogue playground. Why do banks lag? Compliance costs billions, yet profits tempt corners cut. Insider knowledge is their ultimate weapon. Traders train on exact control protocols, then flip scripts. Kerviel prepped fake answers for audits. Leeson spun margin tails. Psychological tricks too. Charm superiors, volunteer fixes, build trust. Adoboli emailed confessions only when cornered. It's social engineering meets finance. Ever wondered if you'd fall for it? These guys aren't geniuses, they weaponize familiarity. Quant models fail on behavioral risks. VAR ignores greed or panic. Traders override limits routinely with business justification, normalizing breaches. Escalation thresholds get gamed. Small flags ignored snowball. Cultural silence reigns. Whistleblowers fear reprisal. Banks preach ethics but chase quarterly beats, breeding cynics. Real-world fixes: segregate duties religiously, automate reconciliations end-to-end, cap trader mandates strictly, AI flags anomalies via network analysis, not just numbers, clawback bonuses on discovered risks. Yet humans adapt. Rogues will VPN through firewalls next. The arms race continues. For you, the takeaway screams due diligence on banks holding your cash. Check risk reports, scandal history, culture vibes from Glassdoor. Diversify beyond one institution. Rogues ripple via contagion. Investing: this vid's no advice, risks abound, DYOR always. Understanding manipulations arms you against headlines. Ponte comodo as we tie threads. Rogues manipulate via hidden accounts, fakes, lags, exploiting culture and tech gaps. Controls fail from silos, dazzle, overload. Lessons: vigilance, ethics, simplicity over complexity. Next, solutions. But reflect, could a rogue hit your bank tomorrow? Tension keeps finance electric. We've walked through the wild rides of Leeson, Kerviel, and Adoboli, seeing billions vanish into thin air from rogue bets. Now you're asking, what have banks actually learned, and how can they stop the next disaster? It's not just about slapping on more rules, it's a full overhaul of culture, tech, and vigilance to keep insiders from turning heroes into villains overnight. Think back to Barings folding like a cheap suit. Could that happen today? Bueno, vamos a ver the fixes that work, why some still fail, and what it means for your wallet in this shaky financial game. No te ligo con eso, because protecting the system protects you too. First big lesson from these sagas: segregate duties like your life depends on it, because it kinda does for banks. No more letting one trader handle front, middle, and back office. That's begging for fraud like Leeson's error account nightmare. Post-Barings, regulators worldwide mandated clear separations, with independent teams verifying every trade in real time. Have you ever split chores at home to avoid one person cooking the books? Same idea here, but with billions on the line. Today, automated systems flag mismatches before settlement, cutting the human loopholes rogues love. Tech upgrades are game changers too. Gone are the days of manual reconciliations that Kerviel exploited with fake hedges. Banks now deploy AI-driven surveillance scanning millions of trades per second for anomalies like unusual volumes or hidden exposures. Machine learning spots patterns humans miss, like Adoboli's phantom clients using network analysis across global desks. But here's the catch: rogues adapt, so banks lay a blockchain for immutable trade logs and quantum-resistant encryption. Isn't it wild how scandals birth tomorrow's tools? Still, no system's perfect without constant updates. Culture shift is the hardest pill. Bonus cultures that reward short-term gambles fueled every rogue we covered. Post-UBS, clawback rules became standard, yanking pay if risks surface later, aligning incentives with long-term health. Training drills ethical decision-making, with whistleblower hotlines that actually protect callers, not silence them. Supervisors get real power now, not just rubber stamps dazzled by P&L stars. Ya sé lo que estás pensando. Does it stick? When boards prioritize ethics over quarterly beats, yes, but greed tempts corners cut. Stress testing evolved massively too. VAR got bashed for missing tail risks, so banks adopted expected shortfall models, capturing extreme scenarios like Kobe quakes or subprime meltdowns. Monte Carlo simulations run millions of market paths daily, probing rogue-like strategies. Regulators like Basel III Force Capital buffers 20% higher for trading books. Ever wondered why your bank's too big to fail? These buffers mean they absorb shocks without taxpayer bailouts. It's progress, but black swans laugh at models. Real-time monitoring killed the time lag tricks. Trades now confirm in seconds via straight-through processing, no windows for fakes. Exchanges demand client IDs upfront, unlike Cymex in Leeson's day, and global data sharing via IOSCO spots cross-border hides. Post Société Générale, France's ACPR mandates trader mandates cap exposures at tiny fractions of capital. For you, this means stable banks holding your deposits or pensions. Páralo si necesitas repasar. These aren't buzzwords, they're shields. Independent audits ramped up too. External firms rotate yearly, drilling into error accounts and override logs with forensic tech. Internal audit reports go straight to boards, bypassing conflicted managers. Behavioral analytics flag trader stress via typing patterns or login anomalies, nipping issues early. Sounds sci-fi. It's standard at JP Morgan or Goldman now. Why do some banks lag? Cost. Compliance eats 5% of revenue, but scandals cost way more. Limits on complexity help too, banning exotic derivatives unless vetted, simplifying products to curb hidden leverages. Trader mandates specify exact instruments, no arbitrage, wiggle room for speculation. Portfolio level caps prevent one desk dominating risk like BFS did Barings. Have you considered how this trickles to retail? Safer banks mean steadier markets for your investments. No advice here, risks exist. DYOR always before diving in. Global coordination tightened post-crises. FSB shares rogue intel across borders, learning from UBS rippling to Europe. Annual rogue trader simulations test responses, from margin calls to shutdowns. Boards include risk experts, not just finance bros. Cultural audits gauge speak-up climates yearly. Progress. Rogue losses dropped 90% since 2008, per BIS data. Yet vigilance wanes. Recent probes show insiders still test edges. For you as investor or saver, pick banks with top risk ratings from S&P, transparent reports, no scandal scars. Diversify across institutions and assets, rogues ripple via contagion. Watch for cultural red flags like bonus bloat or manager turnover. Understanding these lessons empowers smarter choices in a world where one click can shake economies. Isn't finance fascinatingly fragile? Wrapping our rogue odyssey, banks learned segregation, tech, culture fixes shield against repeats, but eternal vigilance rules. From Leeson's Quake bets to Adoboli's ETFs, patterns scream, human flaws need iron gates. You've got the blueprint now. What's your take on rogue risks today? Drop thoughts below, like si te voló la cabeza, and suscríbete for more finance thrillers. This was Rogue Traders putting banks in checkmate. Stay sharp out there.